Okay, before you click away thinking this is just another AI slop video, do yourself a favor. Look closely at this green candle at the bottom. Not just a glance. Actually, look at it. I want you to ask yourself some extremely important questions. Questions that most people never even think to ask. Question 1. Why is this candle green when everything before it was blood red? Question 2. Why is the volume on this single candle so much higher than all the candles around it? Question 3. If everyone was so terrified and convinced Bitcoin was going to 50,000, who had the conviction and capital to buy enough Bitcoin to create this much volume? Question 4. Why didn't the price go lower after this candle? Why did it defend 60,000 and then explode upward? Question 5. What does this candle tell you about who was in control at that exact moment? Now, before we go any further, answer me. Who here bought Bitcoin yesterday when it crashed to $60,000? If you did, drop diamond in the comments right now. Let me see who actually had the courage to buy when everyone else was selling in pure terror. Because what I'm about to show you is going to separate you from the 95% of people who keep losing money on the same pattern over and over again. Think about it. Who was the person selling at this $60,000 bottom yesterday? What was going through his mind in that exact moment? Fear? Absolute panic? Desperation? Get me out now before I lose everything. And here's the question that changes everything. Who was buying everything he was selling? Because while regular people were panic selling at the absolute bottom yesterday, while Twitter was flooded with Bitcoin is dead posts, while YouTube was screaming, sell now or lose everything, while the fear and greed index hit 12, extreme fear, the worst reading in months, institutions were quietly deploying hundreds of millions of dollars. And literally overnight, Bitcoin rallied $8,000 from yesterday's low of 60,000 to today's 68,000, 13% gain in less than 24 hours. This wasn't an accident. This wasn't a random bounce. This wasn't retail suddenly getting brave again. This was engineered institutional accumulation. This was manipulation, not illegal manipulation, but structural manipulation, psychological manipulation. And I'm going to show you exactly how they did it. More importantly, by the end of this video, you're going to learn how to never be the person selling at the bottom again, how to recognize selling climax in real time while it's happening, not the next day when you've already panic sold, how to read volume like institutions do, so you can see exactly when big money is accumulating while regular people are capitulating. And I know this works because I did exactly this yesterday. The moment I saw this candle forming, massive volume, green body, huge rejection wick at the bottom, I immediately posted in my YouTube community, this is selling climax, this is institutional accumulation, this is the bottom. While everyone else was panicking, I recognized the pattern in real time, and look what happened overnight, $8,000 rally. Not because I'm smarter than anyone else, but because I have a framework, with the same framework I'm about to teach you. Why that voice in your head, screaming sell now at the bottom, is literally designed by evolution to make you lose money, and how to override it with systematic structure. The exact 4-phase cycle that every market follows: accumulation, markup, distribution, markdown, and precisely where we are right now. How to identify stopping volume, which is the single most important concept that separates professional investors from emotional amateurs. Why the biggest gains come from doing the exact opposite of what feels safe, and how to train yourself to buy panic instead of selling it. And here's the framework I'm going to use. Wyckoff methodology, created almost 100 years ago by a man named Richard Wyckoff, an investor and analyst who spent decades studying how markets actually work. Not how they're supposed to work in theory, but how they actually function in reality. And what he discovered is still being used today by the smartest, most profitable money in the market. Hedge funds, institutional investors, market makers, they all use variations of this framework because it works. Not sometimes, not occasionally. It works in every market, in every time frame, in every cycle. Because it's based on something that never changes: human psychology. The same fear that made people sell at 60,000 yesterday is the same fear that made people sell at every bottom for the past 100 years. The same greed that makes people buy tops is the same greed that's been making people buy tops since the 1920s. Emotions are predictable, and institutions exploit that predictability systematically. Here's what you're going to learn in the next 20 minutes. Number 1, the complete psychological trap that keeps you selling bottoms and buying tops, and the exact systematic process to escape it permanently. Number 2, how to identify a selling climax on any chart in any market, so you never miss institutional accumulation again. Number 3, what stopping volume actually is and why recognizing it is worth literally thousands of dollars per trade. Number 4, the real reason your emotions are your biggest enemy in investing, and the framework that lets you override them with structure. Number 5, how institutions think about risk, position sizing, and timeframes completely differently than regular people, and how you can adopt their mindset. And here's my promise to you. If you watch this entire video, if you actually pay attention and absorb what I'm showing you, you will never panic sell a bottom again. You will never FOMO buy a top again. You will never be the exit liquidity that institutions need to build massive positions. You will stop transferring your wealth to people who understand structure, because you're going to see exactly how the game is played. Not from theory, not from speculation, but from analyzing what actually happened yesterday with Bitcoin. A real event, real price action, real volume, real institutional accumulation. That happened less than 24 hours ago. And I'm going to show you both sides. The regular person who sold at 60,000 yesterday out of fear, and the institutional fund that bought at 60,000 yesterday with structure. One lost money overnight. One made millions overnight. The difference wasn't intelligence. The difference wasn't luck. The difference wasn't insider information. The difference was framework. So here's what I need from you right now. Hit that like button immediately. This tells the algorithm to show this video to more people who desperately need to understand this. Subscribe and turn on all notifications, because I break down institutional moves like this every single week using real market events. And drop a comment right now with one of two words. Type sold if you panic sold near the bottom yesterday. Type held if you had the discipline to hold through the fear. No judgment either way. This is about learning. Let me see who's watching and where you stand. Because whether you sold or held, by the end of this video, you're going to understand exactly why institutions wanted you to sell, and how they made millions from your fear in literally one day. Let's get into it. Now, before we dive into the technical analysis, I want to introduce you to two people. These are fictional characters created to help illustrate what really happens during these market moves. They're composites based on thousands of real people and institutions I've studied over the years, but they'll help you understand the psychology and mechanics of this manipulation in a much more tangible way. So let me introduce you. Meet Marcus. Marcus is 32 years old. He works in marketing, makes decent money. He's been investing in Bitcoin for about 2 years. He has $15,000 in his crypto portfolio, about 0.21 Bitcoin. He bought most of it, around $72,000 average. He watches YouTube videos about crypto, follows Twitter, checks the charts multiple times a day. Marcus represents retail. He represents most of us. He's not dumb, he's not reckless. He's just operating with the information and emotions available to him. Now meet Victoria. Victoria is 37 years old. She's a portfolio manager at a hedge fund. She doesn't trade her own emotions. She trades data. She has a team of analysts, access to institutional grade tools, and most importantly, she has capital. Not $15,000, not even $15 million. Her fund has $12 billion under management, and she has been authorized to deploy up to $500 million of that into Bitcoin during market dislocations. But she can't just market buy $500 million worth of Bitcoin. That would move the price against her by thousands of dollars. She needs a different strategy. She needs liquidity, and she knows exactly how to get it. These two people participated in the exact same market event yesterday, but they experienced it very differently. Marcus lost money. Victoria made millions. Not because Victoria is smarter, but because Victoria understands the structure of the market. And Marcus reacted to his emotions. Let's watch what happened. Make sure you hit that like button and stay with me, because you're about to see exactly how this manipulation works from both sides. 2 days ago, Bitcoin was trading around $70,000. Marcus was feeling cautiously optimistic. His portfolio was slightly down, but holding. Maybe I should wait for it to get back to my entry price and sell, he thought. But patience won. It could go higher. The halving happened last year. This should be a bull market. Victoria, on the other hand, was watching a different story unfold. Her team's algorithm had identified that Bitcoin was showing signs of distribution phase, extreme leverage building up, ETF outflows accelerating, fear starting to creep in. We're going to see a flush soon, she told her team. When it happens, we accumulate aggressively. Target zone, 58 to 62,000. Then yesterday morning, the floor dropped out. Bitcoin crashed violently. The sell-off was described as the steepest one-day decline since the FTX collapse in November 2022. 70,000, 68,000, 65,000, 63,000. Marcus watched in horror as his portfolio turned deeper red. It's just a dip. Just a healthy correction, he kept telling himself. But the bleeding didn't stop. 62,000, 60,000. And at one point yesterday, Bitcoin touched $60,074. The fear and greed index hit 12. Extreme fear. Marcus's hands were shaking as he stared at the chart. His $15,000 portfolio had shrunk to $13,000, then $12,500. This is going to $50,000, he thought. Everyone's saying the bull market is over. trade war, economic uncertainty, government shutdowns. I need to get out before I lose everything. And at $60,500 yesterday afternoon, Marcus sold. All 0.21 Bitcoin gone. He felt a mix of relief and nausea. At least I saved most of my capital. I can buy back cheaper. At that exact moment, Victoria was on a video call with her trading desk. The capitulation is here. Fear index at 12. Liquidations exceeded 5 billion since January 29th. This is textbook selling climax. Execute accumulation plan. Target zone confirmed. 60,000 to 62,000. Go aggressive. And when Bitcoin touched $60,000 yesterday, her orders hit the market. Not 0.21 Bitcoin like Marcus sold. 7,200 Bitcoin, worth $432 million. That massive green candle you see on the chart? That's Victoria's buy orders absorbing Marcus's sell order. And the sell orders of hundreds of thousands of people just like Marcus. Overnight, Bitcoin recovered to $68,000. Marcus woke up this morning in cash, having lost $2,500. Victoria's fund woke up this morning, sitting on a $57,600,000 unrealized profit. From one day to the next. Now let me show you exactly how this happened. Make sure you're subscribed, because we're about to break down the psychology and the technical structure behind this entire move. Let me walk you through Marcus's experience step by step, because understanding his perspective is critical to understanding how the manipulation works. Phase 1. Confidence fading. 2 days ago, Marcus had been holding since he bought around 72,000. Bitcoin had gone to an all-time high of 126,000 in October 2025. Marcus thought, I should have bought more. But then it started consolidating lower. 70,000 range. Marcus felt okay. Just healthy consolidation before the next leg up. Phase 2. Doubt. Then yesterday morning, the first major red candles appeared. 69,000 broke. Marcus checked Twitter. News about trade tensions, government shutdown threats, economic uncertainty. Okay, this might be a deeper correction. But it's fine. We've seen this before. Bitcoin always bounces back. Some people started getting nervous, but Marcus held on. Phase 3. Fear. The drop accelerated through the day. 67,000 broke, then 65,000. Marcus was checking the charts every 5 minutes. His notifications were going crazy. YouTube, Bitcoin crash, worst since FTX. Twitter, this is the top, sell now. Reddit, I'm out, going to 50K. Marcus's heart was racing. Maybe I should sell, at least take out what's left. But he hesitated. If I sell now and it bounces, I'll hate myself. Phase 4. Panic. By yesterday afternoon, Bitcoin hit 62,000. Marcus's 15,000 was now 12,800. His girlfriend noticed him staring at his phone constantly. You okay? Yeah, fine, he lied. But it wasn't fine. 60,500, then 60,000. The chart looked like a free fall. Marcus couldn't breathe. Every second he was losing more money. This is it. It's going to 50,000, maybe lower. Everyone is selling. I need to get out now. His hands were literally trembling as he opened his exchange app. He clicked sell, 0.21 Bitcoin, market order. At least I'm protecting what's left, he told himself. Order filled, $60,500. Total received, $12,705. $2,295 lost. As soon as the order filled yesterday afternoon, Marcus felt that familiar mix of emotions. Relief. Okay, I'm out. I'm safe. Doubt. What if it bounces? Regret. I should have sold at 70,000 when I had the chance. He closed his laptop and tried to forget about it. But a few hours later, he couldn't help himself. He checked the price. Bitcoin was at 63,000. While Marcus was panicking yesterday, Victoria was completely calm. In fact, she'd been preparing for this exact moment for 3 weeks. Let me show you her perspective. 3 weeks before yesterday's crash, Victoria's team ran their weekly analysis. Bitcoin had peaked at 126,000 in October. Since then, it had been grinding lower, 70s, then low 70s. Her technical analyst presented the data. We're seeing classic distribution characteristics. Retail sentiment is mixed, some bulls, some bears, but leverage ratios are concerning. Too many over-leveraged longs. ETF flows are turning negative. 817 million out in a single day last week. Victoria nodded. And this sets up for markdown. We wait for selling climax. When we see it, we deploy aggressively. 1 week before yesterday, Victoria's algorithm detected acceleration in selling pressure. News cycle turning negative. Trade war fears. Economic data weakening. She sent a message to her chief risk officer. Prepare liquidity for Bitcoin accumulation. Authorization for up to 500 million deployment. Target zone, 58,000 to 62,000. Execute only on stopping volume confirmation. Yesterday, the day of the crash. Victoria wasn't watching the price tick by tick like Marcus. She was watching volume and structure. As Bitcoin fell to 65,000 yesterday morning, she noted volume increasing. Good, but not capitulation yet. 62,000. Volume spiked higher. Getting warmer, but I need to see panic. Then, yesterday afternoon, Bitcoin hit 60,000. And the volume absolutely exploded. 5 times the normal average. Liquidations across the market. Over $1 billion in 24 hours. The fear and greed index plunged to 12. Victoria's algorithm flashed. Selling climax detected. High probability. 91%. She picked up the phone. This is it. Execute accumulation protocol. Defend 60,000 level. Deploy up to authorized limit. Her trading desk went to work. Not buying all at once. That would push price up too fast. But aggressively enough to absorb every wave of selling. 1,000 Bitcoin. 2,000. 3,000. As Marcus and hundreds of thousands like him sold in panic yesterday, Victoria's orders absorbed everything. The price tried to break below 60,000, but Victoria's buy wall was too strong. 59,900, 60,100. No matter how many people sold, her team kept buying. Within that trading session yesterday, Victoria's fund accumulated 7,200 Bitcoin at an average price of $60,400. Total capital deployed, $434,880,000. Marcus's 0.21 Bitcoin, absorbed without even registering. He was one of hundreds of thousands of retail investors who provided Victoria with exactly the liquidity she needed. And here's what Victoria understood that Marcus didn't. She wasn't buying Bitcoin because she had a crystal ball about the next move. She was buying Bitcoin because she'd identified a structural inflection point, a moment where fear had peaked, index at 12. Weak hands had capitulated, liquidations massive. Volume confirmed absorption, 5x average. The mathematics of risk sought reward had tilted dramatically in her favor. Position acquired, Victoria told her team yesterday evening. Now we hold. Let the market digest. The squeeze will come naturally. This morning, Bitcoin was at 68,000. Victoria's fund was up $57,600,000 in less than 24 hours. But the position wasn't for sale. This was just the beginning of the markup phase. Now let me show you the framework Victoria was using. Because this isn't magic. This isn't insider information. This is a methodology created 100 years ago. And it still works today because human psychology never changes. Drop a comment right now. Victoria. If you want to learn to think like an institution, let's see who's ready to level up. Now, before I show you the technical details, I need to give you the framework Victoria was using yesterday. Because what happened at $60,000 wasn't random. It follows a pattern discovered almost 100 years ago by a man named Richard Wyckoff. Richard Wyckoff was an investor and technical analyst in the early 1900s. He spent decades studying price action and market behavior, and he discovered something that changed how we understand markets forever. The market is not random. It's influenced heavily by what he called the composite operator. Today, we call them market makers, hedge funds, institutional investors, or smart money, players like Victoria, with hundreds of millions or billions in capital. And Wyckoff discovered that these large players follow specific behavioral patterns that repeat over and over again across all markets and all time periods. Because the patterns aren't based on the technology of the day or specific news events, they're based on something much more fundamental and unchanging. Human psychology. And human psychology doesn't change. Marcus's fear yesterday works exactly the same way fear worked in 1926. Victoria's accumulation strategy yesterday is identical to institutional strategies used a century ago. Wyckoff identified that markets move in predictable cycles, and at the core of these cycles is a constant transfer of assets, from weak hands to strong hands, from emotional participants to structural participants, from retail investors like Marcus to institutions like Victoria. This transfer happens in 4 distinct phases. Phase 1, accumulation. This is where Victoria and other institutions buy. The price typically moves sideways or slowly upward. Marcus, another retailer, still scared from the previous crash. Volume is relatively subdued on rallies. Institutions are building their positions quietly without pushing price up aggressively. Phase 2, markup. This is the bull market phase everyone loves. Victoria and institutions already have their full positions. Now the price starts rising more rapidly. Marcus starts feeling confident again and begins buying. FOMO kicks in across retail. Everyone wants to get in before they miss it. Phase 3, distribution. This is where Victoria and institutions begin selling. The price is high. Euphoria is building. Marcus is buying more aggressively, thinking we're going to 200,000. Victoria is quietly selling into that retail demand. Volume is high, but the price struggles to make meaningful progress upward. Phase 4, markdown. This is the crash phase we witnessed yesterday. Victoria and institutions have already sold most of their positions. The price starts falling. Marcus is in denial at first. It's just a healthy correction. Then fear creeps in, then full panic. And at the bottom of the panic, right at $60,000 yesterday, we return to phase 1, accumulation, where Victoria buys everything back at much lower prices, and the cycle begins again. Now, where were Marcus and Victoria in this cycle yesterday? The move from 70,000 down to 60,000 was markdown. Victoria had been preparing and waiting. That massive green candle with extraordinary volume at 60,000 yesterday, that was the beginning of accumulation. Victoria aggressively buying, Marcus desperately selling. The perfect transfer. Now let me prove it to you with technical evidence. But first, let me be extremely clear about something important. This is not financial advice. I'm not telling you to buy Bitcoin. I'm not telling you to sell Bitcoin. Let's talk about the markdown phase in detail, because this is where the conditions are created that allow institutions like Victoria to accumulate at favorable prices. Now, Victoria didn't crash Bitcoin herself yesterday. No single institution has that power, but she understands market structure, and she knows how to read the conditions that lead to crashes. 3 weeks ago, Victoria noticed Bitcoin was showing classic late-stage distribution characteristics. The October peak of 126,000 had happened 4 months prior. Since then, steady grinding lower. ETF flows turning negative, $817 million out in a single day. Leverage ratios climbing in futures markets. Retail sentiment mixed, some still bullish, but doubts creeping in. There's going to be a deleveraging event, she told her team. We wait. When weak hands are forced to liquidate, we position aggressively. And she was right. Look at what happened yesterday from Marcus's perspective. Bitcoin didn't just fall in a straight line from 70,000 to 60,000. It broke down in waves. Each wave breaking a support level. Each break triggering more stops. Each stop creating more fear. Wave 1. Break of 69,000 Marcus's reaction. Okay, we're dipping, but this is normal. We've seen this before. Some stops triggered, some weak hands sold, most retail still holding. Wave 2, acceleration to 65,000 Marcus's reaction. This is getting more serious. Maybe I should think about reducing risk. More stops triggered, fear building, but Marcus still holding, paralyzed by indecision. Wave 3, critical support, breaks at 62,000 Marcus's reaction. Oh God, this could really crash. What if it goes to 50? Now Marcus was genuinely scared. Checking charts constantly, sleep disrupted, stomach in knots. Wave 4, capitulation at 60,000 yesterday. Marcus's reaction. I can't take this anymore. Sell everything now. And Marcus sold yesterday afternoon, along with hundreds of thousands of other retail investors globally, all providing the exact liquidity Victoria's fund needed to build a massive position. This is the mechanical objective of the markdown phase. Generate liquidity through fear and forced selling. Victoria didn't need to create the fear. Market structure and news flow did that naturally. Trade tensions, government shutdown fears, negative economic data. But Victoria was prepared to capitalize when that fear reached its crescendo yesterday. Think of it like this. Imagine squeezing a wet sponge. You apply pressure gradually until all the water comes out. Here, the water is Marcus's Bitcoin and the Bitcoin of millions, like him. The pressure is fear created by cascading support breaks and negative news. The market keeps applying pressure through price declines until every weak hand has been squeezed out. Then, when there's literally no one left willing to sell at these prices, the markdown phase exhausts itself. An accumulation begins. The transition point is marked by a very specific technical event. It's called a selling climax. And that explosive green candle yesterday where Marcus sold and Victoria bought? That was a textbook, perfect example of selling climax. Let me show you exactly what that means technically. Quick pause. If this structure is making sense, hit that like button right now and drop a comment. Are you Marcus, reacting with emotion, or Victoria, reading structure? Let me see who's truly following along. This is the most critical part of the entire analysis, because this candle at $60,000 yesterday tells us everything we need to know about what really happened between Marcus and Victoria. A selling climax is a very specific, identifiable technical event in Wyckoff methodology. It marks the precise moment when selling pressure reaches its absolute maximum peak, and then gets completely overwhelmed and absorbed by institutional buying. Let me show you what happened during that candle yesterday from both perspectives simultaneously. Marcus's perspective yesterday afternoon, It's 2:30 p.m. Eastern Time. Bitcoin just crashed below 61,000. Marcus has been glued to his screen for 3 hours. His hands are cold and sweaty at the same time. His portfolio is down over $2,000. Every notification on his phone is bad news. Bitcoin suffers worst one-day decline since FTX collapse. Over 1 billion in liquidations in 24 hours. Fear index hits 12, extreme fear. Twitter is absolute chaos. Told you to sell at 70K. This is going to 40K. Bull market officially over. YouTube notifications. Emergency. Bitcoin crash. Sell now. Marcus's girlfriend walks in. Still watching that Bitcoin thing? Yeah, he mutters, barely able to speak. She sees his face. Are you okay? You look terrible. I'm fine. He lies. But he's not fine. Bitcoin. 60,500. Then 60,200. Then 60,000 exactly. Marcus can't think straight. His inner voice is screaming, "You're going to lose everything. Everyone is selling. Get out now before it's too late." His hands are literally shaking as he grabs his phone, opens the exchange app, clicks sell. 0.21 Bitcoin. Market order. Please, just get me out. I can't watch this anymore. Order filled, $60,500. Marcus closes the app immediately. He can't even look at it. He feels dizzy, nauseated, relieved, terrified all at once. At least I'm out. At least I saved most of it. I can buy back lower. Victoria's perspective. Same moment yesterday. It's 2:30 p.m. Eastern Time. Victoria is in her office, 3 monitors in front of her. Left monitor, real-time price and volume. Center monitor, order flow and liquidation data. Right monitor, fear index, funding rates, and sentiment metrics. She's been waiting for this exact setup for 3 weeks. Her algorithm just flashed bright red, selling climax, high probability, 91%. Volume bar, 5 times the 20-day average. Fear index, 12. Extreme fear, liquidations past 24 hours, $1.1 billion. Price, exactly $60,000. Victoria picks up her phone, direct line to the trading desk. Mike, this is it. Execute protocol alpha. Confirmed boss, accumulation at 60,000, how aggressive? Maximum authorized, defend the level. I want size. Copy, going in. Her traders aren't buying 0.21 Bitcoin like Marcus sold. They're deploying institutional firepower. 500 Bitcoin, 1,000 Bitcoin, 2,000 Bitcoin, market orders. Limit orders at 60,000, absorbing every single sell order that hits the tape. Marcus's 0.21 Bitcoin filled in exactly 0.4 seconds by Victoria's algorithm. He was order number 4,721 in the queue. Victoria's system bought his Bitcoin along with 7,199 other Bitcoin from panicked sellers just like him. The volume bar on that candle yesterday, absolutely massive. But the price? It refused to go lower. Tried to break 59,900. Victoria's buy wall, impenetrable. 59,950, 60,100, 60,300. No matter how hard the sellers pushed yesterday, Victoria's capital pushed back harder. At 2:47 p.m. yesterday, the candle closed. Green, strong, decisive. Victoria reviewed the execution report on her screen. Position acquired. Total Bitcoin, 7,200 BTC average fill price, $6,400 total capital. Deployed, $434,980,000. Execution quality, excellent. Slippage, minimal. She sent a brief message to her fund's partners yesterday evening. Bitcoin position established at structural support during capitulation event, holding for markup phase. The transfer was complete. Marcus's Bitcoin had moved from his retail exchange account yesterday into Victoria's institutional custody, from emotional hands to structural hands, from fear-driven selling to data-driven buying, from weak to strong. And this exact scenario, this exact dynamic, played out yesterday with hundreds of thousands of retail investors globally, not just Marcus, people in America, Europe, Asia, South America, all selling around $60,000 yesterday, all convinced they were protecting their capital, all providing institutions like Victoria with the massive liquidity needed to build enormous positions at depressed prices. This is what a selling climax looks like in real time. This is the moment of maximum transfer. This is Wyckoff methodology, playing out exactly as described 100 years ago. Now, let me show you the technical characteristics that confirm this was genuine selling climax. Drop a comment right now, selling climax, if you recognize this pattern. Let me see who's truly understanding this. Now let me explain the technical concept that separates Marcus from Victoria. It's called stopping volume, and understanding this one concept could save you thousands, or even hundreds of thousands, of dollars over your investing lifetime. Stopping volume occurs when volume increases dramatically, but the price stops declining. This is completely counterintuitive to most people. Marcus was only watching price yesterday. He saw 70,000, 68,000, 65,000, 60,000. His brain interpreted this simply, price going down, bad. Sell before it goes lower. That's emotional, reactive thinking. Victoria was watching volume and price together yesterday as a unified system. She saw something completely different. Let me show you the critical difference. Normal decline, and what Marcus thought he saw yesterday. Volume, low to moderate price, falling steadily. Interpretation, sellers in control, no support, more downside. Likely action, fear. Sell to avoid further losses. Decline with stopping volume, what Victoria actually saw yesterday. Volume, explosively high, 5x average. Price, tries to fall but gets rejected, bounces back. Interpretation, someone with massive capital is defending this level. Action, recognize institutional accumulation, buy alongside them. The fundamental difference, in a normal decline, there are desperate sellers and no interested buyers. In stopping volume, there are desperate sellers and gigantic institutional buyers absorbing everything. Look at the candles before that massive green one at 60,000 yesterday. Each previous red candle, volume moderate, price continued falling. But at 60,000 yesterday, volume explodes to 5 times normal. And what happens to price? It doesn't break lower, it tries. Hits 59,900, then snaps back to 60,300. Victoria recognized this immediately yesterday. Someone with hundreds of millions of dollars just decided 60,000 is the line. We're defending it. And we have enough capital to absorb whatever the market throws at us. Marcus didn't see this yesterday. He was too overwhelmed by emotion to read the structure. He saw volume and thought, oh God, everyone's panicking. I should panic too. Victoria saw volume yesterday and thought, perfect. This is institutional absorption. Time to deploy capital. And here's the thing that makes this so painful for Marcus. After he sold at 60,500 yesterday, he couldn't stop checking the price. A few hours later yesterday, 63,000. Marcus, okay, just a small bounce. It'll crash back down. This morning, 65,000. Marcus, this doesn't make sense. The news is still bad. By noon today, 68,000. Marcus, I sold the bottom. I actually sold the exact bottom yesterday. He wanted desperately to buy back in, but now he was paralyzed by a different emotion, regret. If I buy back now at 68,000, I'll have lost even more money than if I'd just held. I should wait for it to drop back to 60,000, and then I'll buy. So Marcus sat in cash, watching Bitcoin climb, waiting for a drop that never came. Victoria, by contrast, wasn't checking the price emotionally. She'd executed her plan yesterday. Position established at 60,400. Now, hold through markup phase. Sell signals won't come until distribution phase characteristics emerge. That won't be for weeks or months. No emotion, no regret, no FOMO. Just systematic execution of a century-old framework. This is stopping volume. The moment when price tries to fall, volume explodes, and institutions step in to say, this is our level. We're defending it with overwhelming capital. If you can train yourself to see this like Victoria instead of reacting to it like Marcus, you'll never panic sell a structural bottom again. You'll never be the liquidity that institutions need. You'll start building wealth instead of transferring it. Make sure you're subscribed. Hit that notification bell, because we're about to show you what happened after yesterday's bottom. After the selling climax at 60,000 yesterday, we transition into the accumulation phase. Let me show you how Marcus and Victoria experienced the last 24 hours completely differently. Marcus's experience. Yesterday evening, Bitcoin at 62,500. Marcus woke up from a stress nap, and the first thing he did, before anything else, was check Bitcoin. 62,500. His stomach dropped. It's going back up, but it's probably just a dead cat bounce. It'll drop again. I'll buy back at 58,000, get a better entry than I had before. He convinced himself this was the smart play. This morning, Bitcoin at $65,000. Marcus woke up early, couldn't sleep well. Checked price immediately, 65,000. Okay, this is weird. Why is it still climbing? He went to Twitter, mixed signals everywhere. Some people, bull trap. It's going back to 50K. Others, the bottom is in, we're going to 80K. Marcus was completely confused. He decided, I'll wait for confirmation. When it clearly breaks 72,000, I'll know the trend is back up. That's when I'll buy. Midday today, Bitcoin at $67,000. Marcus couldn't focus on work. 67,000. A different kind of panic was setting in. FOMO, fear of missing out. It's really going up. What if it doesn't come back down? But another voice, don't be stupid. You just got burned yesterday. What if you buy and it crashes again? You'll lose even more. Marcus was completely paralyzed, unable to buy, unable to relax. Right now, Bitcoin at 68,500, Marcus couldn't take it anymore. Screw it, I'm buying back in. He had $12,705 in cash. At 68,500 per Bitcoin, that's 12,705 divided by 68,500 equals 0.185 Bitcoin. Before he sold yesterday, he had 0.21 Bitcoin. Now he has 0.185 Bitcoin at a much higher price. Let's calculate his total damage. Original position, 0.21 Bitcoin bought at $72,000 average equals $15,120. Sold yesterday at $60,500 equals $12,705. Loss on sale, $2,415. Bought back today, 0.185 Bitcoin at $68,500 equals $12,672. New position value at $68,500, $12,672. If he just held his original 0.21 Bitcoin at $68,500, it would be worth $14,385. By selling yesterday and buying back today, Marcus locked in a $2,415 loss, reduced his Bitcoin from 0.21 to 0.185. His still down overall, gave up potential recovery. Marcus felt sick, but he told himself, at least I'm back in. At least I won't miss the next rally. Victoria's experience. Yesterday evening, Bitcoin at $62,500. Victoria reviewed her position in her end-of-day report. 7,200 Bitcoin acquired at $60,400 average. Current price, $62,500. Unrealized profit, $62,500 minus $60,400 times 7,200 equals $15,120,000. Her team asked, do we take any profit? Victoria, no, we're still in early accumulation transitioning to markup. Our exit signals haven't triggered. We hold. This morning, Bitcoin at $65,000. Victoria's analyst presented data in the morning meeting. Volume on dips is low. Volume on rallies is higher. This is classic accumulation signature. Victoria, exactly as expected. Other institutions are positioning as well. This confirms our thesis. Midday today, Bitcoin at $67,000. Unrealized profit now, $67,000 minus $60,400 times 7,200 equals $47,520,000. Victoria's reaction, zero emotion. She sent a brief update to limited partners. Bitcoin position performing as anticipated. Holding through early markup phase. Distribution signals remain absent. Right now, Bitcoin at $68,500. Unrealized profit, $68,500 minus $60,400 times 7,200 equals $58,320,000. $58 million in less than 24 hours on a $434 million deployment. That's 13.4% return in one day. That's 13.4% return in one day. Victoria's emotional response? Nothing. Because this isn't the trade. The trade is months long. This is just the beginning. Do you see the difference? Marcus, reacting to every price tick. Changing his mind based on emotion. Selling yesterday and buying today at the worst possible times. Reducing his Bitcoin holdings. Locking in permanent losses. Victoria, executing a predetermined plan. Ignoring short-term noise. Building position. Yesterday at structural lows, holding through volatility, compounding institutional capital. Marcus isn't dumb. He's actually quite intelligent. But in markets, intelligence without structure is worthless. What matters is having a framework. What matters is recognizing where you are in the cycle. What matters is controlling emotion with systematic rules. Victoria has all of that. Marcus has none of it. And that's why Victoria made $58 million in one day while Marcus lost money and reduced his position. Quick check. Drop a comment right now. Are you currently operating more like Marcus or more like Victoria? Be brutally honest with yourself. No judgment. Self-awareness is the first step to transformation. Now we arrive at the markup phase. This is where Bitcoin exploded from 60,000 yesterday to 68,000 today in just 24 hours. And this is where the contrast between systematic thinking and emotional reaction becomes most painful. Let me show you exactly why price moved so aggressively overnight. Reason 1. Institutions like Victoria have completed accumulation. By the time Bitcoin recovered to 63,000 last night, Victoria and other large players had already built their full positions at 60,000 to 62,000 yesterday. They weren't buying anymore at higher prices, so they weren't suppressing price action with their bids. Reason 2, dramatic scarcity of sellers. Think about this logically. Who's going to sell Bitcoin at 63,000 last night after watching it violently bounce from 60,000 yesterday? Marcus already sold at 60,500 yesterday. Other weak hands already capitulated at similar levels. Everyone who wanted to sell had already sold yesterday. What's left? Holders who didn't panic, and institutions like Victoria who are positioned long. Virtually no sellers at these levels. Reason 3, supply and demand mathematics. When there are no sellers and even modest buying pressure enters, price moves explosively upward. This is simple supply and demand. Extremely low supply plus any demand on a rapid price appreciation. And that's precisely what happened overnight. An $8,000 move in less than 24 hours, with minimal resistance. Now let's examine what Marcus was thinking during this rally. Yesterday evening at $62,500, this might be a dead cat bounce. I'll wait for confirmation. Marcus doesn't buy, stays in cash. This morning at $65,000, it's moving up, but I'll wait for a pullback to 62,000. Buy the dip. Marcus doesn't buy. Pullback never comes. Midday at $67,000. This is real, but it's probably overbought on short-term time frames. Marcus doesn't buy, afraid of being wrong again. Right now at $68,500. I can't watch this anymore. I'm missing it. Buying now. Marcus finally buys, driven purely by FOMO, at nearly the top of the immediate recovery move, with maximum emotion, minimum logic. This is the complete opposite of how Victoria accumulated yesterday. Victoria bought yesterday at $60,400 with calm systematic analysis, structural recognition of selling climax, volume confirmation, zero emotion, massive institutional capital. Marcus bought today at $68,500 with panic, FOMO variety, no structural framework, pure emotional reaction, limited retail capital, maximum regret about yesterday's mistake. And here's what makes this so devastating for Marcus. If he had simply held his original 0.21 Bitcoin bought around $72,000, even though he bought too high initially, he'd currently be in this position. 0.21. Bitcoin times $68,500 equals $14,385. Original cost, $15,120. Down only $735, 4.8%. Instead, by panic selling yesterday and FOMO buying today, current position, 0.185 Bitcoin worth $12,672. Original investment, $15,120. Total damage, down $2,448, 16.2%. Plus, he permanently lost 0.025 Bitcoin. All because he reacted emotionally instead of structurally. The painful irony, Marcus was so afraid of losing money that he sold yesterday. But by selling at the bottom yesterday and buying back higher today, he guaranteed permanent loss. He would have been better off doing absolutely nothing, just holding through the pain. But he didn't have the framework to do that. He didn't understand that markdown leads to accumulation. He didn't recognize selling climax yesterday. He didn't see stopping volume. He just saw red candles yesterday and panicked. This is the markup phase, where institutional positions generate enormous profits in one day, where retail either A, missed the move entirely, sitting in cash, or B, bought back higher out of FOMO, where the transfer of wealth becomes complete and permanent, because eventually this markup will transition to distribution. Bitcoin will rally higher, maybe 80,000, maybe 90,000. Euphoria will return, and when it does, Victoria will start selling. And Marcus will probably be buying again, at the top, and the cycle will repeat. Now let me show you the complete psychological trap, because once you see the full structure, you'll never look at markets the same way again. Make sure you've hit that like button. We're entering the final section, where everything comes together. To understand the market, we must examine the cycle through two lenses. Marcus, the emotional retail trader, and Victoria, the structural institutional investor. Their story is the story of the wealth transfer from emotion to logic. When Bitcoin was trading around $100,000, Victoria was methodically selling. She followed a distribution checklist, selling into the buy everything enthusiasm of the retail crowd. Meanwhile, Marcus was buying eagerly, fueled by greed and the fear of missing out, convinced the price would reach $200,000. Marcus bought at the top, Victoria sold at the top. As the price fell from $100,000 to $60,000, Victoria sat patiently in cash. Marcus, however, held through increasing pain, moving from denial to fear. He told himself it was just a correction, while Victoria waited for a specific signal, the selling climax. Yesterday, Bitcoin hit $60,000. This was the moment of maximum terror for Marcus. He sold his 0.21 Bitcoin at $60,500 just to stop the bleeding. At that exact moment, Victoria deployed $434 million, buying aggressively and defending the level. Marcus's Bitcoin moved directly to Victoria's fund. Wealth moved from weak hands to strong hands. In the last 24 hours, Bitcoin bounced from $60,000 to $68,000. Victoria held her position, watching the structure unfold. Marcus, paralyzed by regret, watched the price climb without him. Finally, at $68,500, his FOMO peaked. He bought back in, but because the price was higher, he could only afford 0.185 Bitcoin. Eventually, Bitcoin will rally toward $80,000 or $90,000. Euphoria will return. Marcus will buy more, feeling validated. Victoria, seeing the distribution signals, will start selling to him again. The cycle is endless because human neurobiology, fear and greed, remains constant. To stop being Marcus and start being Victoria, you must internalize 5 truths. First, markets are transfer mechanisms. The market is not random chaos. It is a system designed to move assets from emotional participants to structural ones. Once you see a crash as an engineered transfer event, you stop panicking and start analyzing. Second, volume reveals control. Price tells you what happened, but volume tells you who made it happen. High volume at a bottom indicates institutional accumulation. Victoria reads volume like a signature. Marcus ignores it and only watches the price ticker. Third, institutions feed on your emotion. For Victoria to buy 7,200 Bitcoin, she needs someone to sell it to her. That liquidity comes from the panic of people like Marcus. Institutions need your emotional mistakes to build their profitable positions. Fourth, Wyckoff methodology works because psychology is constant. Richard Wyckoff discovered these patterns 100 years ago. They worked in 1926, and they worked yesterday. The assets change, but the human fear response is hardwired and predictable. Fifth, structure beats emotion 100% of the time. Victoria isn't necessarily smarter than Marcus. She simply has a framework: accumulation, markup, distribution, and markdown. She acts based on where the market is in that cycle, not on how she feels. If this video changed how you see markets, if you finally understand why Marcus loses and Victoria wins, hit that like button right now, subscribe, and turn on notifications. I break down moves like this every week. Now listen, if you're still here, you're different. 95% already clicked away. But you stayed for 20 minutes and learned a framework that's worked for 100 years. The same framework that made Victoria $58 million yesterday, while Marcus lost everything. That takes discipline, and it tells me you're serious about transformation. So prove it. Drop one word in the comments: Wyckoff. That's it. If you comment Wyckoff, I'll know you actually watched until the end. I'll know you're a part of the small percentage who gets it. I'll know you're ready to stop being Marcus. Do it now. Type Wyckoff. Bitcoin crashed to 60,000 yesterday. Marcus sold at the bottom out of fear. Victoria bought at the bottom with structure. Overnight, Bitcoin hit 68,000. Marcus lost thousands and bought back higher today. Victoria made 58 million in 24 hours. This happens every cycle. The question is, which one are you going to be? Next time there's a crash, next time you see that green candle with massive volume, next time every cell in your body screams, sell now. Are you going to be Marcus? Or are you going to pause and ask, is this selling climax? Is Victoria buying right now? What would Wyckoff do? The choice is yours. Marcus will keep panicking. But you? You now have the framework. You've seen behind the curtain. It's rigged, not illegally, but because human psychology is predictable. And institutions exploit it systematically, like yesterday. Now you know. Will you use it or forget it in 3 days? That's up to you. Don't be Marcus. See you in the next one. Wyckoff.